We have value investing and you have deep value investing. So in this video, I want to talk about deep value investing, how to find undervalued stock with a huge potential. Deep value investing is a strategy focused on finding stocks or assets that are significantly undervalued relative to their, investment worth. This approach often involves seeking out investments that are trading at a substantial discount, to their intrinsic value based on based on fundamental analysis. So let's look at the key features of deep value investing. What are the key features of this particular strategy? In this case, we consider number one, intrinsic value. We look at intrinsic value. Um, there's this emphasis on calculating the true worth of a company or asset using fundamental analysis. And this includes, financial statements analysis. It includes, earnings as well as the book value or the net asset value of the company you intend to invest in. Not only that, number two, we equally consider what is called, margin of safety. Margin of safety here, seeks to it's it's a concept actually, that seeks, that seeks to be able to place a kind of safety standards, on an investment. So it seeks investments with a significant margin of safety, meaning they are, periods, they are priced, kind of quite below their intrinsic value. This is made to be able to provide caution, to provide that particular safety, against potential losses. For instance, now, if after analyzing a company, you discover that the price is let's say $10, if you can get the company at maybe $5 or $6 or $7, you have your margin of safety of 5 or 4 or $3 because you are really buying below, the intrinsic value of the company. You see, and so number three is a contrarian approach. Contrarian approach. So often involve investing in out of favor or distressed companies that the market has undervalued, believing that the market will eventually recognize their true worth. That's the essence of deep value investing. You take a contrarian approach. In other words, you behave in a manner that is quite opposite what is expected in the general, what is obtainable in the general market. If the market is selling a shares and the shares plummet, that's the right time for you to go in and check whether there's a potential for a future increase in the market, in the investment, in the stock. In this case, you don't really look at the top 10, the top best performers, or maybe companies in their 52-week highs. No, you go for the ones that are, at the 52 weeks low. That is your fishing ponds. You look for undervalued, neglected, ignored, low priced, lower price stocks compared to intrinsic value. You have that long time horizon. Typically requires patience. It can take time for the market to realize the true worth or the true value of your investment. It might take time. So you have to be patient, wait patiently until the market discovers the potentials of your investment. We want to look at the disadvantages of this strategy. Number one disadvantage is what they call value trap. Value trap. Some investments may appear undervalued, but may have been struggling due to fundamental issues that could persist or even worsen over time. Usually, when the stock is selling at a cheaper price, it is there for a reason. Yours is to discover what are the reasons. Are they just short-term, mispricing, or there's a fundamental, reason why the company is selling at that price. You need to realize that before you talk of buying the stocks involved. Number two is long time horizon. So it can take a long time for the market to recognize the intrinsic value required. Generally it require patience. And also you need to adopt a long time horizon. That's a typical disadvantage. You can't really play the game for the short term. No, it's not applicable in deep value investing. Number three is the market volatility. Investment may remain undervalued for extended periods, leading to potential volatility and uncertainty. As the market remains, as the investment remains undervalued over time, then different level of uncertainty will creep in, and you have to equally bear with be patient with the extent of volatility you are going to face as an investor. We want to look at the advantages here. Is number one, potential for high returns. Potential for high returns. So in this area, if successful, deep value investing can lead to substantial gains when the market corrects its undervaluation. If you are patient enough, you hold the investment long enough, the market will eventually recognize the hidden value in the investments, and then they will key into it, and the price will eventually, rise. Number two is risk mitigation. A significant margin of safety reduces the risk of permanent loss of capital. Generally, when you talk about margin of safety, it's there for you to be able to, should in case you make a mistake in the valuation of the company, that safety, that buffer will help you to mitigate risk. That's what margin of safety is all about. And you equally have investment in fundamentals. Generally, it focuses on the underlying financial health and value of a company rather than market trend or sentiment. When it comes to this particular investing, you look critically at the fundamental. Forget about noise in the market. Forget about market sentiment. Forget about behavior driven by fear and greed. You are logical in your analysis. You have that particular reason. You are guided by logic, not by emotions, and then you carry out your research, your analysis. You certainly come into something that would yield substantial profit for you at the end of the day. We want to look at examples of these strategies. You have net investing. Net investing involves buying stocks trading below their net current asset value. That's a current asset minus total liability. Current asset is an asset that you can very easily turn to cash. You get the current asset, assets you can very easily turn to cash, and then subtract it from the total liability of the company. It's a tall order actually. But if you can find this kind of metrics, I think that company is worth buying. Number two is you have that asset-based valuation. Investing in companies with valuable assets like real estate or patents rather than undervalued, undervalued compared to the market price. Usually, when you talk about asset-based value, you value this company based on the quality of the assets. If you were to strip this company down, how much will you sell the asset of the company? So you now value the company based on those assets, not based on any kind of market inefficiency or discrepancy in the market that could make the price of the investment to go down. No, it is valued based on what? Strictly on asset, not on other metrics. You equally have distressed assets. Number three, distressed asset. Purchasing assets or companies that are under financial distress but have strong underlying value, or recovery potential. Some companies may be undergoing difficulties, may be undergoing kind of temporary difficulties, but the assets are very strong. The underlying assets are quite solid, and they have that potential of recovery in the near future. You could invest in those types of companies. And I would like you to give this video a thumbs up if you like this video and subscribe to this channel. It will do me a ton of good. It will help me to be able to keep on bringing contents of this nature, you know, to you.